So HUIZ Holding Limited, ticker HUIZ, just posted a really massive bottom line beat for the first half of 2026. I mean, total revenue reached RMB 719.8 million.
Right, which is up 5.8% year over year. But, the true standout here is the GAAP net profit.
Oh yeah, it surged to RMB 25.3 million. That is a huge jump from just 2.3 million a year ago, bringing EPS to RMB 0.022.
But the stock reaction gave investors like you absolute whiplash. Shares initially surged 34% on that earnings beat.
And then completely reversed course, plunging 6.51% to close at $1.58. It's just wild.
Yeah, imagine posting record profits, seeing your stock soar, and then watching it all crash because, well, a single bank changed its tune.
Exactly. That drop was directly driven by Citi. They downgraded the stock from buy to neutral and drastically slashed their price target from $7.20 all the way down to $2.30.
Which is brutal. So today we are doing a deep dive into Huize's latest earnings to figure out why Wall Street is severely punishing a company that, on paper, is growing at record speed.
To understand the punishment, you really have to look at their underlying growth drivers first. Gross written premiums hit a record RMB 4.2 billion.
Right, up nearly 30% year over year. And the real catalyst there was first-year premiums, which skyrocketed almost 49% to RMB 2.76 billion.
Wow. For anyone tracking insurance models, first-year premiums aren't just some static metric. They're basically the lifeblood of a broker's future recurring revenue.
Exactly. A 49% jump isn't just a good quarter, it's a massive leading indicator that their sales funnel is converting at a really high rate.
Yeah, and the product mix driving that conversion is crucial right now, especially since we're in this low interest rate environment.
Consumers are actively migrating towards secure, yield-bearing products, and Huize is capitalizing heavily on that strong demand for long-term savings plans.
So if they're bringing in record first-year premiums and riding these macro trends, what does it actually cost them to acquire those premiums?
Well, their expense-to-income ratio actually improved, dropping down to 24.2%.
Which management attributes directly to their AI native strategy, right?
Yeah. They are sinking about $10 million annually into embedding AI deep into both customer acquisition and claims processing.
But wait, how exactly is AI moving the needle on a traditional insurance brokerage, like in practical terms?
Mostly by stripping out human bottlenecks. On the acquisition side, they're using algorithmic targeting to identify and convert high-yield customers rather than using blanket marketing campaigns.
Ah, got it. And on the back end?
They're deploying vision models to instantly process uploaded claims documents. It fundamentally lowers the cost to acquire a customer while simultaneously cutting the administrative overhead of servicing them.
I have to challenge this setup, though. I mean, management is spending $10 million annually on AI in what is basically a low-margin insurance brokerage model.
Yeah.
Is this actually a brilliant competitive moat, or are they just building a luxury engine for an economy car?
Well, look, I'd argue the luxury engine is exactly what this model needs to survive. The whole underlying logic of the AI spend is scalability.
Right, because if you automate it all, the marginal cost drops.
Exactly. If you build an algorithm that successfully automates customer acquisition and claims, the marginal cost of adding the next 1,000 customers drops to near zero. It's a completely necessary moat in a highly commoditized industry.
Except, they aren't just sitting in their core market, letting those efficiency gains compound. They are aggressively expanding internationally.
Yeah, into Hong Kong, Singapore, and Vietnam, where they just acquired the InsurTech platform Global Care.
And that geographic expansion is exactly why Citi brought the hammer down, right?
Bingo. Breaking into new emerging markets means rising customer acquisition costs that their AI simply hasn't optimized yet.
Not to mention dealing with entirely different, highly complex regulatory environments.
Right, and the initial cash burn to establish a foothold is severe. Wall Street hates execution risk.
So the efficiency gains they squeeze out of their core market through AI are essentially getting swallowed whole by the cost of setting up shop in places like Vietnam and the Philippines.
Pretty much. The market is weighing this dual strategy and deciding the near-term cash burn outweighs the long-term tech moat. Trying to digest a new acquisition in Vietnam while simultaneously integrating a $10 million AI stack is as risky as it gets.
When you look at that tension between tech efficiency and geographic expansion, it leaves you with one final thought.
What's that?
If Huize's AI eventually succeeds in automating complex customer acquisition and claims in heavily regulated markets like Vietnam, What is stopping them from licensing their exact same AI engine to their competitors?
Oh, wow.
Could we see them eventually pivot away from being an insurance broker entirely and just become a pure software tech company?
That would certainly change the valuation multiple Wall Street gives them.
Make sure you follow the show for daily, no-nonsense earnings coverage.